Welcome back to Investing Talk Podcast. Today, we are diving into, well, probably the most talked about, maybe most volatile fintech IPO of 2025, FIGR Technology Solutions. And the big question we're tackling for you, based on the material we've reviewed, is pretty straightforward. Is FIGR Technology Solutions a good time to buy right now? If you find this kind of focused analysis valuable, please do hit that subscribe button for us. Give us a like, maybe leave a comment below. And hey, if there's a specific company you want us to look into for a future analysis, definitely drop us a note there too. We really do build these discussions for you. Okay, so FIGR Technology Solutions, or just FIGR. Like I said, high-profile debut recently, and the stock's been, well, kind of a roller coaster. The market pushed the price up fast, showing a ton of confidence, but, the risks seem just as significant. Let's unpack what we found.
Yeah, it's fascinating because you're looking at this real contradiction, right? On one hand, you've got a company with this genuinely different tech model, huge long-term potential there, but then you have these immediate, pretty glaring risks showing up in their financials. And that volatility we're seeing, that's basically the market trying to figure out how to price that exact conflict. It's a crucial moment to analyze them. Hashtag the frenzy and the operational moat.
So FIGR's IPO journey, it really ramped up between July and September this year, 2025. And it wasn't exactly quiet, was it? They actually boosted their offering size and the price range twice before even going public. Huge institutional demand.
Exactly. And when they finally hit the market, September 11th, 2025, they priced at $25. That was already above their target range. Then it just immediately popped, surged 44%, opened trading at $36 a share.
Wow.
Yeah, that initial reaction tells you the market was really hungry for a piece of FIGR. But, the question is why? And I think that gets us to their core advantage, their competitive moat.
Right. And I think we both agree that the why behind that frenzy probably comes down to one really astonishing metric we need to talk about right now. So, FIGR runs this blockchain-based platform mainly for home equity lending, home equity lines of credit, like a second mortgage, basically.
And they built this thing to make lending just radically cheaper and faster. You have to look at their efficiency numbers. Their average cost to produce a loan, it's only, get this, $730.
$730.
Yeah. Now, put that in context. The industry average cost for the same thing, it's about $11,230.
Okay, hold on. Let that sink in for a second. FIGR is doing the same job for roughly 7% of the typical cost. That's not just like a small improvement. That's technology basically disrupting the old way, posing a real threat to traditional lenders. It gives them this huge, possibly sustainable edge.
That's the core story driving that stock surge, absolutely. And it's also about speed. Their median time to fund a HELOC is just 10 days.
10 days.
Compare that to the industry median, which is often over 40 days. So that tech stack they've built, it's delivering 4 times the speed and saving, over $10,000 per transaction.
It makes sense why investors like Duquesne Family Office, who apparently signal a $50 million stake, were so eager to get in.
Exactly. That kind of efficiency is hard to ignore. Hashtag the financial paradox and the risk flags.
But, it is genuinely confusing that you see that kind of like game-changing efficiency, but then the financial reports, they throw up some immediate red flags. Let's get into the fundamentals now.
Right. If you just look at the top line numbers, things look pretty decent. Healthy growth. Net revenue for the last 12 months and in June 30th, 2025 was $375.45 million. Now, okay, the most recent year-over-year growth did slow a bit to 10.1%, but the year before that, 2023 to 2024, a massive 62.7% jump.
And they're making money, right? Profitability seems strong, which usually helps stabilize a stock. Net income for the latest LTM, $62.7 million. That's a 16.5% margin. Big improvement from the $19.92 million in 2024. But here's where I get stuck. You just told us they save $10,000 per loan compared to everyone else, yet they're still burning through cash. How does that work?
And that right there is the critical paradox investors are wrestling with. Even with those strong margins, the EBITDA margin is solid at 36.75%. FIGR reported negative free cash flow. It was negative $40.39 million for the 12 months ending June 2025.
Negative $40 million.
Yeah. And free cash flow, that's the cash left after you pay for operations and investments. Negative means you're relying on outside financing, not your own operations, to fund growth.
So where's the cash going? Is it just the cost of scaling up really fast or something else? It just seems so counterintuitive for a company that's supposedly so efficient.
Well, it likely points to significant upfront investment needed to build out the platform and acquire customers. That's pretty typical for high-growth tech companies, but it's definitely still a risk factor investors need to watch. And there's an even more immediate risk flag that jumped out from the sources. FIGR actually disclosed material weaknesses in internal control over financial reporting.
Okay, material weakness. That sounds not good. For our listeners, what does that actually mean in practical terms?
Yeah, it's serious. This isn't just like a paperwork issue. It's a major flag for auditors, for regulators. It basically means their own audit committee found problems in the processes they use to make sure their financial numbers are reported reliably. And that can really damage investor confidence, even with a great growth story like FIGR seems to have. Because, if you can't fully trust the numbers, the whole investment case gets shaky. #tag product concentration and upcoming catalysts. And there's another angle we need to touch on, operational concentration. So, yes, they facilitated $6 billion in home equity lending, working with 168 partners, which sounds great. But their revenue is still heavily, heavily concentrated in that one area, HELOCs.
Right, so if the housing market takes a dive or even just cools off significantly.
Exactly. Even their amazing efficiency might not be enough to protect them from just broad, market-wide pressure on housing and lending. That's a concentration risk.
Okay, so looking ahead then. Now that the IPO excitement is maybe settled a bit, and we understand this core tension between the efficiency and the cash flow, what are the key dates, the concrete things investors need to watch? Well, the absolute biggest one, right around the corner, is their inaugural post-IPO earnings release. That's set for October 15th, 2025. That report's going to be huge. It's their first chance to really validate or not management's projections. And you can bet everyone will be digging into that free cash flow number and looking for updates on fixing those internal control issues.
Absolutely. That Octave 15th date is critical. Beyond that, we need to track what the big institutional players are doing. Large capital flows really move the needle on liquidity and demand for a stock like this. So keep an eye out for the Q4 ETF and index fund rebalancing announcements. Those usually happen around October 25th. And then maybe even more importantly, the quarterly 13F filings. Those show who's been buying. They come out around November 20th. If we see major funds starting positions and figures, that could really stabilize or even boost the share price.
And then there's the speculative side, right? The rumors that can move the stock just on headlines alone. What's buzzing there? Two main things seem to be popping up. First, chatter about a potential major crypto or blockchain partnership, something to maybe broaden their whole tokenized asset ecosystem beyond just lending. Second, we're hearing talk about maybe an accelerated push into international lending markets, using their digital tech globally. Oh, and also those persistent whispers about getting included early in some high-growth tech ETFs. That would create automatic buying pressure, a huge demand driver.
Yeah, those are definitely things people are speculating about. Potential catalysts, but obviously less certain than the earnings date. #tag technicals and final investment thesis.
All right, let's quickly touch on the technical picture as of, say, late September 2025. What's the chart telling us? Well, after that initial big surge, the price seems to have been consolidating a bit. Lately, it's been trading mostly between $34 and $44. Last close was around $39.25.
Technically speaking, yeah, there seems to be some key support holding up between $36 and $37. That's kind of important because it's near where the stock first opened after the IPO. Resistance looks like it's up around the $42 to $44 level. And momentum, if you look at something like the RSI indicator, it's pretty neutral right now. Suggests the market's kind of pausing, maybe holding its breath for that October 15th earnings report.
Makes sense.
So, okay, let's try and tie all this together, all the contradiction, all the potential. What's the overall investment thesis for FIGR? Based on everything we've looked at, we're giving FIGR Technology Solutions a pretty balanced score. Let's say 6.5 out of 10 overall.
Okay, a 6.5. So sort of cautiously optimistic, but with significant reservations. And that rating really boils down to this tug of war, right? Between that incredible future potential promised by that, $730 cost structure versus the immediate, very real instability coming from the negative cash flow in those internal reporting issues.
Exactly. The strengths are clear. That operational mode is real, the growth potential is there, and they did show early profitability. But the concerns are just as serious. Negative free cash flow is a big one. They're burning cash to grow. Then you have the material weaknesses in controls, the high revenue focus on HLOCs, and it's just the general regulatory uncertainty around digital assets. The volatility is sort of moderate for now, post-IPO. But the long-term picture, that really requires them to fix those internal control problems and, critically, show a clear path to generating positive free cash flow consistently. That's the main hurdle FIGR needs to clear to really justify its current valuation, I think. #tag outro.
So wrapping this up, what does this all mean for you, the listener, asking that core question? Is FIGR Technology Solutions a good time to buy now? Well, synthesizing everything from the sources, it feels like the stock right now might be better suited for short-term trading, especially given the technical setup and that big catalyst coming up on October 15th. But for a long-term investment, it seems like it holds that potential, but probably only for more sophisticated investors. People who really understand fintech scaling risks and are comfortable tolerating the financial uncertainty and the regulatory headwinds inherent in such a disruptive business.
Yeah, I agree. And maybe here's a final thought for you to chew on. You've got this incredibly efficient operation, right? That $730 cost per loan versus over $11,000. It's a massive advantage. How much weight should you or the market put on that game-changing efficiency compared to the immediate risks? The negative cash flow, the internal control issues. Which factor efficiency or financial stability do you think institutional investors and maybe even regulators will prioritize when they really start judging Figure's path forward after those October 15th earnings? Something to really consider as you think about your own potential entry point.
That's an excellent point to end on, a real balancing act. Thank you for joining us for this analysis of FIGR Technology Solutions. We appreciate you tuning in, and we'll catch you next time on Investing Talk Podcast.